Hello there! Part 2 of Lecture Series 20 on IFRS 16 Leases focuses on lessee accounting. IFRS 16 requires lessees to recognize a right-of-use asset and a liability for all leases. However, as discussed in Part 1, a simplified treatment is allowed if the lease is short-term of low-value asset. On initial recognition, the lessee shall recognize a right-of-use asset measured at cost. IFRS 16 stipulates cost shall include the following. 1. The amount of the initial measurement of the lease liability. This shall be discussed in the next slide. 2. Any lease payment made at or before the commencement of the lease. 3. Any initial direct costs incurred by the lessee. And 4. The estimated cost to be incurred by the lessee in dismantling and removing the underlying asset, restoring the site, or restoring the underlying asset as per condition of the lease. A lease liability on initial recognition shall be measured at present value of the lease payments payable over the lease term. The liability shall be discounted at the rate implicit in the lease if this is readily determinable. Otherwise, the lessee shall use their incremental borrowing rate. IFRS 16 stipulates that the lease payments shall include the following. 1. Fixed payments less any lease incentives receivable. 2. Variable lease payments that depend on an index or a rate, initially measured using the index or the rate at commencement date. Example includes payments linked to the consumer price index or payments that vary to reflect changes in market rental rates. 3. Amounts expected to be payable by the lessee under residual value guarantees. 4. If the lessee is reasonably certain to exercise the option to purchase the asset, then the exercise price of the option shall be included. 5. Termination penalties if the lease term reflects the expectation that these will be incurred. In calculating the initial amount of the lease liability and right-of-use asset, the lessee must consider the length of the lease. IFRS 16 states an entity shall determine the lease term as the non-cancellable period of a lease together with periods covered by an option to extend the lease if the lessee is reasonably certain to exercise the option, and periods covered by an option to terminate the lease if the lessee is reasonably certain not to exercise the option. On subsequent measurement, the carrying amount of the lease liability is increased by the interest charged and reduced by the cash repayments. A lessee shall measure a right-of-use asset using cost model unless the right-of-use asset is an investment property and the lessee fair values its investment property under IAS 40, in which case the right-of-use asset shall also adopt the fair value model, or the right-of-use asset relates to a class of property, plant and equipment that the lessee applies IAS 16's revaluation model. In this case, the lessee may apply the revaluation model to all right-of-use assets in that class. A right-of-use asset measured using the cost model shall be carried at cost less accumulated depreciation and impairment loss, if any. Depreciation shall be calculated as follows. If ownership of the asset transfers to the lessee at the end of the lease term, depreciation shall be charged over the remaining useful life of the asset. Otherwise, depreciation shall be charged over the shorter of the lease term and the remaining useful life of the asset. The next part of Lecture Series 20 will focus on separating components of contract, reassessing lease liability, lessee presentation and disclosures.